So, what is the lemon problem? This concept was introduced by Nobel Prize winner George Akerlof in 1970. The lemon problem describes a situation where sellers usually have more information than the buyers, leading to different perceived values of goods and risks. The term lemon in this concept is referring to a vehicle or item of poor quality that decreases the value and utility of the item. In his book, George Akerlof used an illustration of the automobile industry to illustrate the impact of lemons in the market. He argued that in a market where a potential buyer has no way to ascertain the value of the vehicle, the buyer will pay no more than an average price to minimize the risk of receiving a poor quality vehicle. Ironically, this will discourage the seller of a premium vehicle from entering the market, as they are unlikely to receive a fair price that reflects their vehicle's true value. Eventually, good quality vehicles will be driven out of the market, resulting in poor quality vehicles or lemons dominating the market. So the lemon problem demonstrates how information asymmetry can lead to a market inefficiencies where sellers of high quality products are not properly rewarded. This concept is not only applicable to the automobile industry, but it also extends to financial markets. Take, for example, in the loan market, where borrowers usually have more information about their ability to repay than lenders. So, as a result, lenders may increase interest rates to cover potential risks, which can drive low risk borrowers out of the market and leave only high risk borrowers behind.
Thank you, Putra. Now, I would like to present about my slide, which is how lemon problems relate to corporate debt. Firstly, adverse selection occurs when investors are unable to distinguish between good and bad firms that issue corporate debt. In the point of view of investor perspective, they are unsure which firms are safe, so they demand high interest rate to cover the average risk. This rate benefit bad firms and penalize good firms. So, the good firms will react in this way. They know their bonds are undervalued, so they choose not to issue their bond. Meanwhile, for the bad firm strategy, they are willing to issue their bonds because they know their bonds are overvalued. But because of this action, the investor will begin to lose confidence. In this slide, I will talk about why corporate debt markets fail. It will be divided into two sections, which is adverse selection in action, where this adverse selection plays in the real market, and the second one, the consequences, the impact and effects of this adverse selection in action. Firstly, for the adverse selection in action, the good firms will exit the bond market. And then after that, only low quality firms, or we call lemon, is issuing debt. And lastly, investors will become reluctant to buy this corporate debt in the market. Next, I will talk about the consequences. In this case, we have three consequences mainly. The first one is misprice risk. Misprice risk is when good firms pay too much in terms of the interest, but at the same time, the bad firms are taking advantage of this situation. Secondly, financing gaps. This happens when fewer bonds is issued, so eh, it has less capital for good firms. And lastly, there will be investor withdrawals. This is because loss of trust and shrinking market participation. Next, I would pass this presentation to my group mate Akif. Thank you.
Okay, so today I'll be explaining how the lemon problem, which is a concept in economics, applies not only to a private market but also in government debts. So, just a tiny bit of recap. The lemon problems, as we know, occurs when buyers cannot accurately assess the quality of a product. Because of this uncertainty, they offer a price based on the average quality. As a result, sellers of high quality product leave the market because they felt undervalued. This is behind only the low quality or basically lemon products. So how does this apply to government debt? So basically, when government issue the bond to raise money, investor they try to evaluate how risky it is to lend them money. But the problem is government usually have more information than investor. So this create the first problem, which is the asymmetric information, which basically mean only the government knows the full truth about the economic health, the political stability, and the hidden debts. So what happened is, because investors can't tell which government are truly stable or not and which are hiding risks, so they basically try to play it safe. So they assume that all government are of average quality and therefore offer average interest rate that are actually too high for strong and stable government. So this is where the lemon problem start to show. So government with strong fundamentals and sound policies are basically discouraged from issuing bonds in the public market. So why are they discouraged? Because they don't want to pay unnecessarily high interest rate despite investor suspicions. So they seek alternative financing from a safer sources like maybe central bank or international lenders. Meanwhile, the weakest government, especially those with poor policies or hidden risks, are still happy to issue bonds at these inflated rates. So since the market can differentiate their risk, as a result, the bond markets slowly become dominated by these high-risk issuers. Investors begin to lose confidence and interest rate rise even more. This creates a vicious cycle of distrust and instability in the government bond market. So to basically summarize it, the lemon problem in the government debt occurs when, due to the asymmetric information between the government and the investors, this causes good quality government to exit the bond market and seek the finance other place, leaving behind riskier ones, damaging the trust and stability of the entire system. So that's basically that's basically how the lemon problem applies to the government debt. So I hope this have give a clear understanding of how the market failure like the lemon problem can affect something significant as government debt. So we move on to the next slide, which is the real life example of the government debt in the world. Thank you.
Good day, everyone. So today I'll be explaining about the Eurozone crisis, a major financial and economic crisis that deeply affected several European countries starting in late 2009. It was not just a financial issue, but one that tested the foundation of the European Union and the euro currency itself. So the Eurozone crisis was also known as the European sovereign debt crisis, which was a period when several Eurozone member states faced serious financial difficulties due to high government debt levels and concerns over their ability to repay those debts. So the crisis mainly impacted countries like Greece, Ireland, Portugal, Spain, and Cyprus. There were several interrelated causes behind the crisis. First, some countries, especially Greece, had been borrowing successively over the years, and their budget deficit exceeded what was allowed under the EU Stability and Growth Pact. Second, the 2008 global financial crisis triggered a severe recession across Europe. Tax revenues dropped while governments spent more on stimulus and bailouts, worsening public finances. Third, the Eurozone lacked a central fiscal authority. While all members shared a single currency, they had a different national policies for taxes and spending. This mismatch created structural weaknesses. And the fourth is the banking sector was highly exposed In Ireland and Spain, for instance, housing bubbles burst and bank collapses, requiring state intervention. Finally, investor confidence plummeted as doubts grew over whether the countries like Greece could repay their debts. Borrowing costs soared. This made it even harder for these countries to refinance their debt, deepening the crisis. So Greece was the epicenter of the crisis. It was revealed in 2009 that Greece had been understating its budget deficit, which shattered market trust. Eventually, Greece needed 3 separate international bailouts to avoid default. Ireland's crisis came from its banking sector, which collapsed after the property market burst. The government had to step in and guarantee all bank debts, which overwhelmed public finances. Portugal and Cyprus also required bailouts due to similar structural weaknesses and debt problems. While Spain faced a different challenge. While its government debt was not extremely high at first, its banks were exposed to a massive housing bubble. Spain received financial assistance specifically for its banking sector. So, to prevent the total collapse of the Eurozone, the EU and IMF launched several rescue packages. The European Financial Stability Facility, which is a EFSF, was created in 2010, later replaced by the European Stability Mechanism. The European Central Bank also played a vital role. Under Mario Draghi, the ECB launched a program to buy government's bonds and restore confidence. One of the most impactful was the Outright Monetary Transaction program, which is essentially guaranteed support for struggling countries. And Draghi's famous word is, whatever it takes, help calm the markets. In return for this rescue package affected, countries had to implement strict austerity measures, such as cutting spending and raising tax and enacting economic reforms. The crisis had devastating consequences. Millions lost jobs and poverty rates increased, and there was significant political and social unrest, especially in Greece. The austerity measures, while necessary for long-term sustainability, were painful for ordinary citizens. On the other hand, the crisis pushed EU to improve its governance. Banking union reforms were introduced to supervise European banks more effectively. There is now greater awareness of the need for a closer economic and fiscal coordination. In conclusion, the Eurozone crisis was a major turning point in European economic history. It revealed critical flaws in the Eurozone structure, tested the limits of European unity, and prompted significant reforms. While the worst is now behind us, the lessons from this crisis continue to shape EU economic policy today. That's all from me.
Now, moving on to the decision. Does government debt, like corporate debt, get affected by the Lemon problem? Yes, it does. Why? This is because, similar to corporate debts, investors of government debt may not always have complete and accurate access to the relevant information on government bonds. Now, these include gaps in information such as the government's creditworthiness, the sustainability of said debt, the effectiveness of the specific government's economic policy, the country's political stability, and hidden, unreported, misreported, underreported, or misrepresented liabilities. These are all crucial information for investors when evaluating the risk of said government debt. So without it, investors may not make or may not have the full understanding of the risk rating of said government debt. Now, however, there are exceptions to this true statement that can make it a false statement. This occurs in cases of good governance where all the relevant information is transparent and easily and readily accessible.
Now, if we come to the conclusion part, the Lemons problem happens when investors can't distinguish between high quality and risky borrowers because of information gaps in both corporate and government debt markets. Now, this leads to higher interest rates for everyone. As a result, good borrowers leave the market, leaving only risky ones, which lowers overall quality and hurts investor confidence. Now, for governments, since they know more about their finances than investors do, investors demand higher rates to protect themselves. Now, this pushes responsible governments out and lets riskier ones take over. Now, the Eurozone crisis is a perfect example. Hidden Greek debt problems caused borrowing costs to rise for weaker countries, showing how information gaps can destabilize entire countries.